Okay, we're recording a class here on November 13th, 2014. And I just want to go through a little class of going back to the basics, back to what it really takes to chart the markets. It's easy to throw all sorts of indicators up on the charts and try to use them to analyze the markets, whether it's a buy or a sell. So if we were just to take any one of these charts, and let's just take this one right here, and then let's make this a 5 minute, and let's make this a 5 minute chart. They're all the same chart. So if we leave this one naked with nothing on it, and we were to add a template. So we're going to use the template of IML03, and that's giving you some indicators, and I'll get into that in a moment. And then we're going to look at the moving average. Okay, the moving average. All right, 1MA1. Here it goes. Okay, so you have the same charts. It's all the same charts. If you see here, 1, 2, and 3, except that chart number 1 has no indicators. Chart number 2 has what we call a Keltner channel. And I apologize in advance if my dog is going to bark. There's some construction next door, and it's making her a little bit crazy. So if you do hear some yapping in the background, just disregard it. All right, not gonna, can't apologize for Ronnie. She's a dog. And you have a moving average here in the middle, and you also have what's called the 310 oscillator, which I had gotten from Linda Raschke, who I had worked together with for 14 years at LBR Group. And that originally came from a guy named Walter Brescher, and he invented or developed the 310 oscillator. So this is what that is. And if you want more information, you could always email me at chris@imarketslive.com. And then we have another thing that I always use is moving averages. These are your 79, 89, 100, 250, 3, 4, 5, 600 period moving averages. And I use them for support and resistance levels. I determine trend and all that good stuff. Well, if you don't know how to use this and somebody else has developed it, then what good is it if you don't know what you're looking at? For instance, this is my little baby right here. I know how to read it. I know when to use it, when to look at it, why to look at it. And then I use it in conjunction with Fibonacci ratios, swing highs, swing lows. And guess what? It's my baby. And then when somebody else tries to use it, they say it don't work. The same as this. All right. There's many people that said this don't work. Well, it can't work if it's not yours and you don't understand it until you take the time to understand it. But it all comes down to one thing. It comes down to understanding price. And price is the main thing to understand. So what we're going to do is we're going to load back our price chart. All right. And you're going to load back your price chart. Now, I don't care what indicator you have, quite honestly, it doesn't matter to me. It's all about reading price and how to better yourself in the markets by reading just price. So one of the basic things you want to look at is I like to look at multiple time frames. You got a 1 minute chart, a 5 minute chart, a 15-minute chart, a 60-minute chart, a 120-minute chart, and a daily chart. This is NinjaTrader. It's our preferred platform to trade with, our preferred platform to chart with, although we do use MetaTrader for the signals for Forex, and we also have it for the futures markets in NinjaTrader, and NinjaTrader is actually good for both futures and Forex. And what I like to do is I like to keep it basic at all times. Even to this day, 20 years in the market, I keep it basic, basic, basic. What does that mean? Well, the most important things on your chart are swing highs and swing lows and price patterns. So taking away all the Fibonacci stuff, taking away all the other things, okay, I like to look at where's the market trend. So I start from the highest time frame and I work backwards down to the lowest time frame. I look at the highest time frame and I look and see where support is. I look at where resistance is. Okay, and looking at this chart, you gotta obviously say to yourself, well, the market's in an uptrend. And believe it or not, some people actually think we're in a bear market already. All right, we're not in a bear market unless it was actually a bear market and the market's going down. The market's been trending up, whether we like it or not. And okay, what I have to do is just hold on a second, gang. Okay, so market is in an obvious uptrend. All right, so we want to start with the highest time frame, and this would be the daily chart that we're using. Okay, we don't really need the weekly in this case, all right, unless you're doing some other stuff. So if we just look at this chart in particular, what stands out at us, all right, let's just look at a couple of things here, right? You got your swing low here, you got a swing high here, and what has happened, market's in this uptrend, all right, and let me just fix this, all right? So right here was a key area, okay? Key area, swing high. As you can see, the market pushed up into this zone, chopped around, resistance, went above, came back as support, went above, came back as support. So going back to the basics, this is telling you that this whole area is a key level, the same as this area was in this respect. So if we take this, we take all these little swing highs right into here, you could see that when the price came down into this area, it respected all these little price levels, these swing highs. So market rallied up, all right, and then came down. It came down again today on this chart. And what do we see here? Swing high, swing lows, and you could see how price has respected this whole area. You're in an uptrend. Flushes will be supportive, right? And you can see here, just looking at the prior lows here, prior high. This was a major spot for the market. So when it tested down, it found support. You don't need any fancy indicators to tell you what a swing high and swing low is. It's basically right on your chart. So if we start going into lower time frame, we can start looking at how you would chart the market, what to look for, when to look for it. All right. For instance, right here, see right there, swing high. Now, we didn't sit and trade these because we had a million other things happening and we look at so much. But for those that want to be chart aficionados and really grasp the basics, then you need to start looking at this stuff in terms of your own charting, because don't worry about all the indicators. They mean nothing, right? They don't. They mean nothing unless you understand what price is doing. Let's take a look right here, okay? Gonna cover that. We're gonna here. We're gonna look here. Okay, we're gonna look here. All right, and we're gonna stop right there for a moment. Could actually even look right here. All right there, like that. So just looking at price, the market broke out of resistance, rallied to the upside, then came back and tested right here. You could see this little spike, ran up again, came down again, tested this area. This whole area becomes a support. You're always looking at prior swing highs and swing lows, or what we call structure. You're also looking at where the market has created a lot of sideways action, and that also works as a key support, a key resistance zone. All right. So in this case, the market had its rally and then came down, and you could see it held the prior swing. So something in this area, you would put your stop down here. If you were buying, you put your stop down there, plenty of room away from the noise. Same thing here. Market, when it came back up, it tested what we call a test. This is a test of a prior swing high, or what we call a retest of a prior swing high. Market went sideways, 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 and then broke out above it. And what that means is now this resistance has become support. Any pullbacks down, this is expected to hold. So if you're looking at this chart as a whole, this area, it doesn't just look like that anymore. It looks like this, okay? All right, it looks like this, okay? So now you have this whole general area as key support, key resistance. What I like to do often enough is I draw in my trend lines. I draw them here, I draw them here, I draw them here, like this. And I find little highs and lows to work with. All right, I look at every little swing high and swing low, and I try to determine where is what we call a value area. Value means that where most of the action has taken place. You don't need market profile charts to tell you where quote unquote value is. All right. Market found a fair price in this area, is holding, continues up, and then tests down again. So where did it test? It tested to this whole range, this whole base up here. Even though it's at all-time highs, it still has very key support below. So markets don't just necessarily shift from going up to down in a trend until a lower high and a lower low, and then a lower high and a lower low is in place where you have a failure. So in this particular case, you have a solid uptrend. Now, if we take this high down to the low and it made new highs, it comes back down. And if we look at this whole general zone here, and I go back to the rectangle, all right? You see this whole area right in there where all these overlapping bars are? I like to look at that. And what I do a lot is I take the upper end of it to the lower end, right there like this, and I draw all my little spots where price support and resistance come in. So if you start to look at this, this whole area is now what we call a value. So when price tests back down to it, it's going to find support. So if you're trading this, your stops would be down here. Now, granted, you have a 27 entry and your stops would be down at 21, but that is what it is on a 120-minute time frame. You can't deny that it's a higher time frame. And then you find your support and you come up again. So now you have a bunch of action right here. You can see all this right here. And the market's holding it. Once it lost it, see, it had to move it with force down to support one more time, and now it's coming up. This is obviously going to now become a key resistance area on any test back up. So what we're going to do is we're going to go to the next time frame, which would be the hourly chart. Let's take a look at that. All right, let's take a look at that. As you can see here, we define more these sideways areas. So what I like to do is start looking at all these price bars up here, swing highs. So what I do with my charts, I like to draw in my vertical lines. I take the range highs, the range lows, and where they overlap one another. All right, and what do we see here? Okay, all this data in here. It's a lot of overlapping action. From this little swing high also right in there. This little swing high in here. So all this is now starting to become important to me, that if the market does move up into this area, I know that it's going to be hard to get above it. Now I start looking at below. The market has had two tests already. If it comes down here for the third time, that's not going to look pretty for the market. I would expect that if price happens to now test this again and lose it, where would we look below? We would look at your prior swing lows. So here, 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 you see that? This becomes important. So if you're looking at, say, shorting the market into resistance and it does test down, this would be your first area to exit. You could just see all this little price action. So this would be the first area to exit. All right. So your first test was a buy. Now, if you're looking to exit up here or you're looking to short, then you exit. If you're looking at the market for a much deeper move, then you got to start looking at levels below. So if we look at right here, here to here, essentially, you could just see where all this came into play. Now I'm going to show you something we did this week on a trade that we did for the market for the service, and I'll show you how that played out and what it looked like. But I'll get to that in a minute. Anyway, so we're looking at these higher time frames, and we continue to go down to the lower time frames. We start looking at now where are these little swing highs and swing lows. See, every time frame is different. They all work together, but you're knowing now that this up here and this and this and this and this and this is all right. This is all data that was left behind. All right. All data was like all these little swing highs and lows were left behind. You could see right here. These are points of support and resistance. This is a resistance. Right down here, you can see how the market tested this morning exactly. So you're looking at areas where the market would test and find a support and resistance, and then you use that in your favor. So if we're looking for the market, because now you had impulse to the downside, it's undeniable, although it did hold its first test. Now you're looking at what happens if it comes back up here. You had one test, two tests, three tests. That's telling you something that the market did fail to the downside, that if it comes back up again, you could be pretty sure that it's going to be a tough road to get above because you have to overcome all these little swing highs to make a new high on the market. It doesn't just go up and that's it. It respects prior highs, prior lows, and that's how when we look at the markets and we do some charting and trading, that becomes real important. For instance, this is a 5-minute chart. All right, the 5-minute chart, here's your swing high, here's your swing low, here's a swing high, here's a swing low, here's a swing low. You see all this, right? You see all this in here? This is important. This is important data, right? So right in here, okay, all this little area, you're now going to say to yourself, if the market comes down to this area, it should be respected as a support, and where could it go to the upside? So the upside, you already had your first test, okay? So if we come down into this area again, it would be expected to be supported and respected, and maybe if they try up again, this is going to be the key area. The first one is this, and then up here one more time. So if you were looking at this as a trade, for instance, you would look at this, and this is on a demo, so it's on our simulator. So if you were looking at this and you were looking to buy it, you would start putting in bids, all right, in these areas. You would start looking at buy limits like this, all right. If you're doing multiple trades, you would start looking at, for instance, oops, alrighty. You would start looking at buy limits in these zones. All right, obviously. All right, little swing high here. Well, it didn't fill, but you can see the point is you're looking at how you could layer in. You would layer in some trades. All right, that's how I would look at it. You would layer them in into your little spots. But we come above this, we're looking to get up into this zone up here. This is a key area for the market. Remember, all this up here is data to watch. Market is still trying to come up. Now, if I'm looking at this in terms of how we typically look at things in terms of maybe harmonics, when we draw out the patterns, and I know we love to draw out these fancy patterns, it's still the same thing, all right? Still the same game, but you're looking at key little areas of support and resistance to work from. It's the same thing. When I look at trades, it's literally the same thing, all right? I'm going to put the video on pause for a second. Okay. All right. So in respect to swing highs and swing lows, let me show you, maybe if I could get it up there, a trade we did this week and for the live service. It was GBP USD. Let me see if I could GBP USD. Let me see if that'll work. Of course, there's an error. Okay, let me fix this. Okay, we're continuing. All right, I put the how to fix the video. All right, so this is the daily chart of the GBP USD, and earlier in the week we did a trade. It was on the hourly time frame, and once it loads, we're going to go through it. All right, and I laid it out in a video that we did, and that way you guys could understand, and we'll just wrap up this class so you can see. All right, we did the video. We actually did it and posted it to the website. So here we go. So using swing highs, swing lows, using prior data, all right, we want to look at where the market support and resistance can be. So when we were looking at a trade this week, we looked at the swing highs, all these little swing highs in here, little swing lows. We looked at all this data, all right? I disregarded this right here, actually. That's where the stop went. So we looked at all these little swing highs and swing lows in this area. All right, this was an actual trade we did for the signal service. So those of you that are on the signal service, you would know what I'm talking about. And we were looking at potentially the market to go from here to here, and then it came down. We were looking at the market when it came down, and we were looking at this whole zone to layer in buys. Now we took, I believe we took 3 positions, 3 entries on this. We're looking to add on the way down, and we were looking to buy because this whole area, looking back to the left, is structure for the market, overlapping price bars, swing highs, swing lows. We were looking at buying this whole move down and putting our stop down here. All right, we had our stop. Oops. All right, we had our stop down here. So we looked at this as the last resort, the swing low, but really this is what we were looking at. Just color all that in real thick. All right, that's how I want you to vision this. All this. This is a shooting across saying, okay, we were priorly here, we're important, and the market has to struggle all through this to get down here. So when we saw the markets come in, we looked at this and we felt that this would be a buy and that the upside could possibly equate to this move back up. All right. But what were we looking at and how we exited was at this swing high right above here. When prices got back up into this area, we exited because of this prior swing high. You see this? We use swing prior data, prior swing highs to enter the trade. Now, we drew out the potential that we were looking at was our quote unquote harmonic patterns in market geometry, which we use at all times, and I love using them. We were looking at a potential for what we call a Gartley pattern. That if the market did get up into this area, you have to be real cautious. And let's look at why. All right, let's look at why. What were we looking at the time? Swing lows, swing highs, swing lows, all this prior data. You see all this data in here? Okay, all this junk. All right, all this prior data right here. So if we were to take this line, draw it right across, it's telling you all this information shoots across and it's telling you major resistance, major resistance. So when price pushed above here, we were kicking out our trade that we bought here, kicking them out, exiting, and we were sitting back patiently. If it would have got up into this area, we could have shorted them. Of course, it did, it held a little bit low. But the fact is, you could see here the test, the rejection, back up again, the rejection. This all was major resistance. The market knows that. It's within the context of a downtrend. You could see it went a lot lower. So Let's proceed to see what happened. Price impulsed into this area. Look at that, right? It's consolidating in this whole area that had happened in the past. It's respecting these lows. I had created a bearish flag under the prior low. It's respecting this as a resistance now. You see? Path of least resistance is down. There's nothing below. Major resistance above. All right? So, you have to basically respect swing highs, swing lows, uh, data, okay, overlapping price bars. You have a lot of overlapping price bars. The worst is to trade in this because you're going to get hurt. The best is to wait till it gets out of that range and then try to trade it, okay? Because then you can utilize the market uh, impulse and use this as a spot of resistance and support. So if I was to, for instance, if the market, let's just say we watching this just this one market, okay? And we broke down out of this data here, and I said, okay, first bounce we're going to short. We shorted them, all right? Hypothetically, your resistance will go up here. It'd have to take a lot to get up there. So even if it came back up and swung around, that's fine. The fact is it continued to go down, and then once it starts going sideways, it's telling you something else, all right? So same respect, highs, lows, prior swing, prior data, and that's really how I look at the markets, how I chart the markets. And, I hope this really helps you in looking at how to analyze the markets, getting back to basics, getting back to just the simple things, not having to be so complicated and put up all these moving averages and everything. It's just you don't need them. The only thing you need is one thing: price support, price swing highs, prior data, and that right there is going to keep you on the right side of the market. Rock and roll. Have a great rest of your day.